Hello and welcome back to part three of our mini-series on budgeting your cash value. I wanted to take a minute before we dive deeper into different ways to use the spreadsheet to just talk through a concept and a principle, I guess, that is important as you're putting your dollars to work in your policy. One important thing that I want to make sure to be very clear about is that this is a whole life insurance cash value life insurance policy. It's designed for cash accumulation, but it is life insurance, and it's important to make sure that you keep enough money in the policy's cash value at all times, especially in the early years of the policy, so that you don't run risk of lapsing your policy. So let's talk about that for a minute, and I'll show you how you can use your budget to do that properly. So as you can see here, we're looking back on Susie and Bob's cash values, and we're still looking at the last videos. And if you haven't seen part 1 and 2 yet, go back to those first 2 videos in our playlist to see all these videos in order. But please notice that they've intentionally put $22,000 there in their emergency fund as of June 15th, 2020. And that's not on accident. It's important to make sure, especially in the first few years of your policy, that you've got plenty of money set aside as a buffer. It's not to be seen as a bank account or a checking account. These policies are not the same thing as your, grocery money and so forth. These are really meant for the emergencies, opportunities, and large expenses that you have in life. We did a few podcast episodes on this exact topic, and you can look through our Not Your Average Financial Podcast list to find the 8 rules when you bank on yourself for policy loans. And you can also look up the rules of thumb for policy loans episodes that we've done. But in principle, just to summarize those episodes, especially in the first few years, I would recommend keeping at least half of your cash value set aside in the emergency fund. You could also call that the buffer account. And that half of you're able to borrow as much as 90%, even in the first few months of your policy. And it's your right to take 100% out if you want to close out your policy. But I'm recommending, usually a best practice is to keep 50% of your cash value set aside in the policy, especially in those first few crucial years. Why is that? Well, life happens is the short answer. There's a possibility that for whatever reason, the loan can't be repaid as you planned, a policy loan can't be repaid as you planned, or possibly the premiums have to be put on hold due to illness or job loss. And that buffer account, that emergency fund, could also be used to help cover the premium expenses for your policy if you had to. Again, the best case scenario is to pay your premiums out of pocket or other lump sums and savings that you have. But the policy itself can be seen as best and in its healthiest state when we aren't ripping all the money out of that policy for especially small things, small purchases, doodads, that sort of thing. Again, the key here is to think like a banker. This is not a bank, of course, it's a whole life policy, but it gives you the mindset of a banker to think in terms of how do we properly structure our balance sheet as a banker might think of it, right? So this whole life policy's cash value really does need, especially in the first few years, an ample amount of money sitting and set aside, not to be touched, for emergencies only. And that might include the need to cover any existing expenses, including the whole life insurance premium. So one thing that we want to be very clear about is that emergency fund can be kept set aside and for only emergency purposes. Now, as you get more into your policy, let's say 5-6 years in, for example, maybe you're able to dial that down some. You don't need 50% of $1 million sitting in there possibly if you had $1 million in 5 or 6 years in the policy. But it's meant to be sort of a guideline or a principle. So if you have enough money, I'd say more Americans would be better off if they had 1 to even 2 years of their living expenses in liquid cash set aside in case they lost their job. And that might include also covering the expenses of this policy too. So I just wanted to have a video briefly before we go further into how to use this budget on the principle of the buffer account or the emergency fund, as we call it here on this screen. It's not just for your living expenses, groceries, etc. if you lost your job, but it's also possibly just to keep the health of your policy in good order, especially in the first few years of your policy. So hope this short video has been helpful. And again, if you'd like a copy of this tool, reach out to us at hello@nyafinancialpodcast.com or go to our website, nyafinancialpodcast.com, click on request a meeting, And in the notes of the meeting agenda, just say that you'd like to talk about this Think on Yourself budget tool, and we can talk more about how to implement this in your portfolio. Hope all's well. Talk to you soon.